Thanks for joining us today for our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, as the U.S. has positioned military assets near Iran, the probabilities of a strike have seemingly increased here, and we've had several inbound client questions last week around the investment impact. So, we'll start with our chart of the week. So, the most obvious impact could be to the oil markets. This chart shows the percentage of crude and all fuels that flow through the Strait of Hormuz. Should that shipping pathway be closed, it could negatively affect about 20% of global fuel supply. Of course, there could be adjustments globally, but oil has been rallying this year in part due to the risk that the strait is closed. Now, lower oil prices have had a positive impact in bringing inflation down. Through the end of January, oil had fallen about 20% in 12 months. But should oil continue to build on its year-to-date rally, it could be an upside risk to an already sticky inflation picture. For now, the inflation backdrop is benign. So this chart here in orange in the bottom clip is plotting the Ned Davis Research inflation timing model, and that's comprised of over 20 leading indicators of inflation. It's currently consistent with broad disinflationary forces, but we'd pay attention if this model began to turn higher. The general disinflation trend that began in the middle of 2022 has been a positive influence for this bull market. Now, as it pertains to the impact on stocks, NDR keeps a list of so-called crises events. Now, these can include financial crises, military strikes, terrorist activities, and natural disasters. We can see that on average, the stock market has tended to experience a near-term drawdown, but then recovered in relatively short order. Now, this time around, the military buildup is well known, so we'd expect that the market is already discounting, at least somewhat, the potential impacts to the stock market. Now, last week, the Supreme Court struck down the tariffs imposed under IEEPA. The Trump administration quickly pivoted to a different route that allows 150-day tariffs of up to 15%. Now, our friends at Strategas put this table together in order to estimate the impact of tariff change. Now, in total, as highlighted in the bottom of the table, they project that total tariffs would drop about 70 billion over the next 12 months. Now, in a vacuum, the reduction in tariffs should be stimulative on net. And that adds to the tax refunds, which are tracking higher at this point in 2026 than in the past 4 years. So consumers and business stimulus should be picking up. Now, the timing of stimulus probably really couldn't come at a much better time as economic growth has cooled in 2025 compared to economic growth in 2024. And the fourth quarter GDP disappointed, coming in at 1.4%. Now, when we dig into that number, though, due to the elongated government shutdown, we find that most of the growth shortfall did come from a reduction in government expenditures. Consumer spending and investment continue to hold up well in the fourth quarter. Now, there are some downside risks to growth, especially owing to softening wage numbers, but for now, the expansion remains intact. Now, we briefly touched on inflation when we discussed Iran, but it's notable that inflation hooked higher at the end of last year. The Fed's favored core personal consumption expenditures, or PCE index, is sticky at 3%. Now, that's still a full percentage point higher than the Fed's target. The Fed is maintaining an easing bias, but sticky inflation is complicating matters. As of today, the market implied probability of a rate cut by mid-year is 50%. If inflation were lower, it would likely be a higher percentage chance that the Fed would cut rates again as they work to get back to a more neutral 3% target. Now, turning to market sentiment, one fascinating development has been a market that's been in a bull, but investor sentiment is at pessimistic levels. Now, the bottom clip in orange here shows a near-term sentiment gauge from Ned Davis Research, and we can see that investors are broadly pessimistic. Now, we would chalk that up to a rotational market where the biggest stocks have tended to lag. geopolitical concerns, and an uncertain trade backdrop. But that said, market participation or trend evidence remains healthy. So this chart in orange shows that the percentage of individual industries that are in bull markets, and that's at about 2/3. And that reading is a healthy reading, albeit not an extremely strong one. So the implication of weak sentiment amid an ongoing bull market with healthy participation is that we're likely in a mature bull, but a bull market nonetheless. So this chart in blue shows all the instances back to the mid 1990s when sentiment has been pessimistic, but market trends have been positive. Note that returns have been about average 1 year later. We continue to give this bull market the benefit of the doubt, but recognize that returns are becoming more dispersed, consistent with a maturing bull market. So, our closing thoughts for the week is that Iran and the potential implications, those are near the top of investors' minds, and rising oil prices and inflation could present a risk, particularly as disinflation has been a tailwind for this bull market. Now, historically, events like a military strike have tended to resolve higher following an initial negative reaction. Now, tariff policy is also top of mind given the Supreme Court ruling last week. Now, Strategas estimates a reduction in 70 billion of projected tariffs, and that's likely stimulative, and that is to say nothing at all of potential tariff refunds, which we're not quite sure how that will work going forward yet. Now, stimulus could help economic growth to remain steady or maybe even accelerate as the year progresses. Softening wages do present a risk, but those tax refunds are at least a partial offset. Now, inflation has remained stubborn, keeping the Fed in a holding pattern here in the near term months, and a rate cut by mid year is just a coin flip. It would likely be a higher probability if inflation were lower. Now, the headlines are contributing to negative market sentiment despite solid market trends. And historically, weak sentiment amid an ongoing bull market is consistent with a mature bull, but a bull nonetheless. So that's what we have for you this week. And as always, I want to thank you for joining and wish you a great week ahead.